Thanks all for coming. You notice anything different? This has got to be worth a couple of quid on the share price, this new logo of ours. Surprising how much effort it takes to change a logo, and nobody seems to even notice it. So, guys, really pleased again to be standing here with a great set of results. Revenues up 50%, profits up 60%. It's no mean achievement for the business. And before I get into the rest, just want to say thanks to all my colleagues at Keywords around the world, and indeed to our clients who continue to support us as we build this global games services platform. So my section to begin with, quick overview of the business and where we are. So the first thing to talk about is the opportunity within the video game space. As you know, we focus entirely on this area. It is a niche, but it's a large niche. It's $100 billion and it's growing anywhere between sort of 6 and 8%, depending on which analyst you follow. Games are becoming more and more part of our lives. That they're spanning the age groups and they're spanning the demographics. More and more women are playing games and more people in more countries are playing games. And they're playing games on more devices than ever before. And most importantly, I suppose, on the ubiquitous smartphone, which is continuing its charge to penetrate all corners of the universe. Important for us, a couple of things to say about what's happening in the market. We're delighted with the success of the Nintendo Switch. That's brought to the market a third major console that's been missing for the last few years. And with that comes games that are made specifically for that device, and also work that happens in porting games from, for instance, the Xbox or the PlayStation to the Switch. Another factor and a driver for us, and we see this most in, for any of you analysts that follow the major publicly quoted games companies, you'll see this reflected in their results as well, is this change in the nature of the business from being a packaged product business to a services business. And what that means is that it's now all about content and all about continuously providing content to the players. You know, it costs money to acquire a player. The way in which you retain a player is by creating more content so you can keep them engaged in your game. We continue to benefit from virtual and augmented reality. Augmented reality, particularly at the moment, there's a lot of focus on that. As for virtual reality, you will appreciate that Keywords is right in the middle of it. These experiences, interactive experiences using virtual and augmented reality require the use of games engines, and a lot of that work finds its way to us because it requires specialist skills for the art creation, it requires specialist skills for testing and so on, and indeed for audio production. The market that we face for our services, we estimate is about $5 billion, and around 50% of that is currently outsourced. So our opportunity within what is currently outsourced is about $2.5 billion. But there is obviously, as we've mentioned before, a fairly strong trend towards outsourcing generally in the industry. So our opportunity increases as that happens too. Part of the Keywords story is this development of the global games services platform. As you know, we've made great strides in turning ourselves into a global business. We've also been adding service lines to the organization and filling in some of the specific expertise so that we can provide services to our clients around the world on a come in, turn it on, turn it off basis. And that's playing out very well with clients, as we'll see when we get into some of the stats about how many clients are buying how many services. But as we go through this game's lifecycle, there are still opportunities for us to expand our capabilities into some areas, which we intend to do over time. So what the business looks like today, I'm a huge fan of balance, and try as I might, I haven't yet managed to get this circle completely balanced into sevenths, but we're still working on it. So our localization business, the text translation business within games, continues to grow at pace and continues to account for 30% of our overall revenues. This, I should say, is not on a pro forma basis, it's on an actual revenue reported basis. So on a pro forma, the picture is a little bit different. Some other sort of standouts, I think, on this is obviously the engineering services business. This is a new activity for us. In the 6 months, it only represented 1% of the business. It's about a $5 million business in GameSim as a whole. So on a pro forma basis, it would be a little bit more than 1%. But it's really just us dipping our toe in the water for that, and we fully intend to build that engineering services business so that we make it a meaningful part of the circle. As we go into some of the details in terms of where we're experiencing the highest growth, you will see that areas like functional testing are growing strongly, as is customer support, to help give a bit more balance to that picture. It's becoming a bit sort of cluttered with all these studios we've got around the world. I think we're up to 36 studios. What I would say is worth noting is quite how well distributed we are as a business. So in Asia, we have 1,200 people. In the Americas, we have 1,000 people. And in Europe, we have about 600. So in my view, you know, we're in the right places, we're in the right geographies, and our resources are deployed in the right geographies as well. Asia is the largest single market for video games. Not only that, though, it's also the largest market for video game talent. So one of the reasons we're so strongly present in Asia is because of the access to art resources, for instance. You know, across the globe, you'll find us. We will be close to clients, close to clusters of video game companies, but we'll also be in places where it's really about the access to the talent. So a place like India, for instance, there isn't a lot of game development going on in India, but it is an area where you can find great talent. 23 of the top 25 game companies are clients of Keywords. It's worth saying that this top 25 changes every 6 months or so. It's an independently published leaderboard. So the clients that we have might fluctuate a little bit based on, you know, who appears in the top 25 from time to time. But those are all well-known names. I think there are one or two that you haven't seen before on the slides. Cyber Agent, for instance, is one. But we remain very well penetrated in terms of leading game companies around the world. Few highlights of the progress we've made since IPO. I have to keep reminding myself we've not actually been doing this for very long. We started with our IPO in June 2013, so we've achieved a lot. I think in June 2013 we had 5 studios, for instance. So this business is building itself at an incredible pace. And while we're building like that, we're also delivering on our numbers. So this sort of activity that you see in Keywords would often be carried out in the sort of shadows of a private equity owner or something. And they wouldn't necessarily be doing it the way we're doing it, with delivering profits and cash generation as we go through this. So I'm particularly pleased that we're able to do both. It's no mean feat. Some things on this chart I would just like to call out. One of them, and perhaps most pleasing for me, is the progress we're making with our cross-selling efforts. You can see that we've gone from having 60 clients buying 3 or more of our services 12 months ago to 84 clients buying 3 or more services. And that's a trend that we continue to see growing. A reminder that we have about 400 clients in total, right? So there are still 320 odd clients that only buy 2 or less services from us. Revenue growth, obviously, David will go into details a little bit more on this, and then I'll come back and talk to you sector by sector as to how that growth is made up. But while we're growing our revenue, we're also growing and maintaining our net operating margin, which is coming in at around 15%. The business is also becoming more diversified, not only geographically and by service line, but also by client. So back in 2013, we were very dependent on 2 or 3 clients, as you can see from the pink line. But coming into 2016, we actually have no single client representing 10% or more of our revenue. I have to say, I look at that line and I think, ooh, that looks nasty, you know. All keywords graphs always point up to the right. So I try to persuade my colleagues to change the scale so that we started at 3 and went up to 0. So we had an upward facing line, but they said no. The other thing to notice here on the bottom is in blue, you can see the revenues for the first half by sector, first half of 2017 by sector. And I think mentally you can double that or so and see that we're going to be nicely ahead of 2016 for the full year for pretty much all of those service lines, with a slight question mark over audio. So I'm going to hand over to David to take you through some of the details on the numbers.
I suppose we've obviously given you the trading update previously, so that captures the revenue and the PBT which was reported. The dividends per share, obviously we continue our kind of progressive dividend policy, up 10% year on year. Net cash and the Barclays facility as well are kind of well-established news at this stage in terms of what we've shared with you previously. I won't linger too long on this because most of this is kind of repeated. Obviously on the income statement, we're very pleased to see the revenues up year on year, 50%, strong growth. All of that managing to maintain the gross margins, marginally up on the same period last year. Again, another kind of pleasing result in terms of the performance for us. Another area which was a stated objective for us was to tackle the centralized overhead and try and leverage that as we grow the business. Again, we've seen some kind of progression there, down to 20.1%. Finance costs, we've obviously stepped up the Barclays facilities as we've made more acquisitions. So again, there's been a marginal increase in terms of the finance costs as a result of that. And then the adjusted profit, which we reported previously as well, again up strongly by 60% in the period. Effective tax rate, again a bit like the centralised overhead, another area that we've kind of targeted to make steady progress in. So again, at this point, we're looking at a rate that's going to come in lower than last year. We'll continue to work on that. I suppose one area in that is we've brought in a group tax manager, which is a newly created role. And they're very much focusing on the group structures and operations and looking to, I suppose, maximise that for us going forward. Adjusted EPS, again, up strongly in line with a lot of the other metrics by 55%. Balance sheet, again, net cash of 1.1. I suppose it's key to kind of point out that our half year is obviously when we're in full throttle in terms of delivering for our clients. This is our kind of our low ebb in terms of cash. We obviously finished the year a lot stronger where we're harvesting in a lot of the money and that's our high point. Again, net cash, which is positive, that after 6.6 million in terms of cash considerations for the acquisitions, a small element of deferred consideration which related to liquid development, and then obviously the acquisition costs and integration expenses, which are down marginally year on year. MMTCs, again, is another area that we continue to make strong progress on. We've just got clearance now that we should be getting in what we've accrued for 16 and within the next month. So again, the legacy that you've seen in previous years where there's been a bit of an overhang, we are collecting within the year, post the year, for the full amount that we've accrued. Capital expenditure, again, 1.8 million, marginally up year on year. Again, we're same kind of areas in terms of continuing to put into hardware and computer equipment as we scale and grow the business. Some particular sites which we've decided to invest in, Montreal, Tokyo and Dublin. And then obviously ongoing investment into the art service line. So very similar to what you saw at the full year, the same kind of centres, the same kind of service lines being invested in and being grown. Cash flow, again, as I kind of touched on there, up marginally in terms of cash conversion relative to the half year last year. Again, it's lower than what you usually see at the full year because of where we are in the cycle. It's probably the worst point in terms of the year that we could probably pick to look at that. Again, it's our high point in terms of cash requirement. Dividend, again, we pointed out that we're continuing our kind of progressive dividend policy of the 10% year on year. Debtors days, again, is an area that we continue to kind of make progress. I'd just be kind of keen to point out if we had stripped out Red Hot, which came out or came into the group just right at the tail end of the half year, you would have seen a lower figure again. So good discipline in terms of debtor collection and progress being made throughout the group on that. Guidance, again, you know, what's in our DNA, it's organic and acquisitive growth. We don't see that sliding off. You know, we continue to look for acquisition targets and we continue to put strong organic growth into the business. In the organic vein, again, we're looking to invest in 8 facilities across the group. I think it's important to point out this is a significant investment back into the business because of the opportunity that we see ahead of us. That's spread across multiple sites, multiple service lines for us globally. And again, we're going to obviously have a CapEx commitment within that. We're also going to have a marginal OpEx coming through some incremental headcount as they come on stream, and the things like new premises, rents, and other associated kind of OpEx costs that we'll incur as a result. Interest expenses, again, we've upped the Barclays facility. We now have that standing at a balance of about 13 million, up from 8. So you will see, as we use that and we draw down on it, some incremental interest costs. Tax rate, again, you've seen the progress that we've made at the half year relative to the full year. We'll continue to work on that. We think somewhere in the region of about 1% per year, kind of coming off, topping out at about a 17-18% group rate is probably the stated target. And then the positive cash conversion is obviously a trend that we hope to continue. We've obviously made the improvement year on year in terms of H1, and we'd look to finish on a high at the full year in terms of that being our cash peak.
Right. Bit more detail, service line by service line. But again, some sort of highlights for the first 6 months. Particularly pleasing, I think, again, is our very strong organic growth. Difficult to know quite how to portray that. So sort of at the lower end, I would say it's kind of 17%. If you strip out synthesis, which we have already mentioned, had a particularly sort of exceptional first half of 2016. If you strip that out, the like-for-like growth is much higher at about 28%. So I would say the real like-for-like growth is somewhere between those two numbers. And as I've pointed out before, very nice progress with our cross-selling activities. We also, as you've come to expect from us, made a number of acquisitions in this period, in the first half, and actually since then, up to date. So we've actually acquired 7 businesses. I'm not going to talk about them here other than just to update you on the latest acquisitions because we haven't had a chance to talk about those. Those were the acquisitions in France where we actually acquired 3 separate businesses, and together with the business that we already owned in France are putting them all together in a sort of state-of-the-art facility which we'll be building out during the course of next year. So these are all audio-focused businesses. They all do voiceover for video games. They're all specialized. And as you'll notice from this, there are 4 of them at least in the one city. So it gives you an indication as to the fragmentation of the business generally. But these are all 4 leading, 3 of them are leading players in the market. And obviously by putting them together, we have overnight got ourselves a leading position in the all-important French audio recording market. And, you know, if you look at how audio recording is done and where companies start, pretty much every video game has at least French in it. So, and French is just regarded as somehow a little bit sort of a notch above all the others, just because they're French. I don't know. So, you know, that puts us in a fairly sort of commanding position, not only for that language, but obviously spinning off of that into the other languages as well. So, segment by segment, or should I say service line by service line, take you through some of the highlights. We've tried to get the bar charts to portray the picture properly, but it's not always easy because at a small scale you can't necessarily see the increments. But for art creation, the business grew very strongly, but a part of that was due to acquisitions. Sort of allowing for the acquisitions or stripping them out, or however you want to do it, on a like-for-like basis, the business grew 22%, so it continues its strong organic growth. A highlight, I think, for this segment was the fact that we acquired Red Hot in China, and Red Hot came with 4 satellite locations in addition to its main hub in Shanghai. And we've very successfully already put together the management teams of both Mindwalk and Red Hot in a very complementary manner. And we are leveraging those satellite locations, we're investing in them, and we're finding that you know, we can access more talent and hopefully at a higher retention rate than we can in the major cities of Beijing and Shanghai. So we're very optimistic for the future of our business in China with those 2 leading the charge. Our audio services business, this has actually been held back a bit, even allowing for that huge synthesis couple of months in May, June of 2016. The business actually went backwards by 10% on a like-for-like basis. Nothing to worry about there. It's just that the audio business tends to fall, the big audio projects, just the way in which the game development cycle works, they tend to happen round about June time. So you can either have them fall into the first half of the year or fall into the second half of the year. And I think basically we're looking at a year where the projects are just falling into the second half of the year. Localization, the translation side of the business, this continues to just grow like a train. I was speaking to the leader of this service line recently, just on a quiet chat. I think he was in his mountain house somewhere in Italy, and I don't know where I was in the world, but we were chatting generally about it, and he was saying, it just feels like it's reached a certain tipping point, and Keywords has become the go-to player for game localization. So a lot of this is just, you know, incoming work all the time. It's also nice to see that having acquired the Xloc business, which is a software platform, it's designed to manage, it's highly sort of technical, but it's designed to manage the localization assets, so the text assets in a game, and it connects directly to the game engine. But it gives the game developer nice control and security over those assets, such that he knows what he's getting back and what's been translated and what hasn't, and make sure that those later strings are incorporated in the game and not the wrong strings, which is a surprisingly common feature of game development when the wrong stuff gets incorporated into the game. But that is being integrated within some of our clients already. And work is going on to integrate it further downstream into our workflow for translation. Moving on to functional testing. This has grown tremendously this year. It's also benefited, of course, from the acquisition of Enzyme, which I think was November, December 2016. But even allowing for that, it's a 70% increase, like for like, and some of the investment that David mentioned earlier is going in to support the further growth of functional testing. Part of the reason for this particularly large increase in this period has been a particular large demand from one of our managed services clients. So we have a number of clients where we actually manage the functional testing operations within their facilities. And one of those clients just had a very big year as well. So that was part of the reason why we had such a stellar growth in functional testing. Localization testing, it's had a slightly slower growth, still 6%, so that's not bad, but it looks a bit slow compared to some of the other service lines. The only thing I would say there is what we are seeing now is more and more mobile games getting what I would say is proper attention for localization testing, whereas in the past they perhaps didn't receive the investment that perhaps they deserved. And I think that's a general trend with mobile games. They're becoming higher quality, they're becoming longer lived games, and perhaps the developers are now confident enough to invest more in them. And quality counts. So you see this trend towards 3D art assets going into games, into mobile games. We're seeing more and more audio go into games, and we're seeing more localization testing going into mobile games as well. Customer support grew nicely, up 57% on a like-for-like basis, purely organically. Very nice to see this business unit leveraging the Keywords studios around the world, putting in really solid teams, very selectively recruited staff, providing a very high quality service, dealing with players directly on behalf of our clients. And the final service line is engineering. Don't really have a comparative for that, but other than to say, expect us to be continuing to invest in that going forward. There's a lot of talk in the market now about the demand for what they call co-development services. So as games become bigger and bigger, so development studios need to leverage teams outside of their own internal studio. I think this is going to be a strong feature for us going forward if we make those investments in the engineering service line. So, strategy. Again, you've heard all this before. I think what's important to understand is we don't only say it, we get out there and do it. But what we will be continuing to do in terms of our organic growth strategy is continuing to leverage these customer relationships that we've got. So as I said, we focus on the larger game companies around the world. We have about 400 of them. There are probably another 3,000 companies out there in the games market. But we focus on the larger players. And we are leveraging those relationships. We have a very trusted relationship in most of those cases. It's a very recurring relationship. We've been supplying those companies for some years now. And we're able to build on those relationships by introducing them to new services that Keywords can offer them around the world. We're going to be continuing to extend our services. As I said, we're building on this foothold that we've created in engineering. And we will be expanding into some other areas as well. Called out here are things like visual special effects, game trailers, and so on. But there's a bunch more as well that are kind of the fill-in type nature rather than creating a whole new service line. And then in the audio business, we continue to build these pillars of single language capability, just like we already are by far the leading provider in Italy. We're the leading provider in Spain. We're now the leading provider in France, and you should expect us to continue to build these pillars of capability. And finally, in terms of our geographic reach, as you saw on the map earlier, we're pretty well positioned around the world. But there are still some areas where I think we would benefit from being present in. One of those is Eastern Europe. And there are places like Korea, for instance, that we still need to address. In terms of our acquisition strategy, what you should expect from us going forward, well, acquisitions are an integral part of our DNA. We've set ourselves up to do these. You should be expecting us to make, I don't know, between 4 and 10 of these sort of smaller type acquisitions every year. By smaller, I mean anywhere from, a couple of million to $10 million in size, in consideration terms. Possibly find that, the odd larger one falls into our hopper as well. We're continuing to build the audio service, as I said, so acquisitions will fall into that camp. Art production continues to be something that we can continue to grow through acquisition as well as our strong organic growth. And functional testing, if we find the right acquisitions, we will happily include those to add to the tremendous progress we're making organically. New service lines, expect us to make some acquisitions in the engineering space, and geographically, as I've said before, Eastern Europe would be nice for us, and Southeast Asia holds some interesting opportunities for us in terms of art. How we manage this growth going forward, you've seen this chart before. I'm just going to call out the investments we've made in the management team since last time. So we've added a global HR director in the form of Jerry Cleary, who's based out of our headquarters in Dublin. But also worth noting that underneath this team, we've been filling in some important positions. So we've added a couple of senior positions to our IT team. So somebody to head up the application side of the business worldwide, and somebody to head up the infrastructure business worldwide. Also into David's team, as he said, he's introduced a tax manager for the first time. So we have somebody focused on corporate structure and tax, which is great because there's plenty to do. But also, for instance, we've just employed our first full-time acquisitions person coming from transactional services at a professional services firm, that sort of background. So, we do these acquisitions within the operating teams, but, we have enough on the go that we could have somebody just to help us with some of the ongoing due diligence management. Some of the sort of key efficiencies and synergies we're making as we build this business, and it's important, again, for those that don't know us so well, we do get on and integrate our acquisitions. So we're not just buying businesses and leaving them as standalone entities. We are getting on and putting them onto common operating platforms. We're leveraging them in terms of Salesforce, for instance, which is a common global Salesforce. We do try to cross-fertilize with talent we've got in various locations. And very much leverage the geographies we've got. Having an operation in a country, let's say like China, where you've got people on the ground that know the ins and outs of doing business there, that know the HR regs, know the whole setup, makes it much easier than to seed in another service line. And we're becoming very good at doing that. Also, of course, as we make some of these acquisitions, companies like Enzyme, for instance, that we acquired recently, there are some good operational synergies to get out of those acquisitions right from the beginning, right? We don't need another CEO or something. You don't need multiple facilities if they're in your neighborhood and you can combine facilities. So we're doing more of that sort of consolidation as well. So key opportunities as we move forward. You should continue to expect us to produce good organic growth. We are operating in a growing market, and I think the demand for our services is actually growing beyond the general market growth. Strong cash conversion. I know measured at this half-year point, it doesn't look great, but it will look great by the time we get to the year end, as you saw last year. The acquisitions that we will continue to make, these smaller acquisitions, we have put in place this facility from Barclays, which gives us up to 35 million euros. That should be enough to cover most of these small acquisitions. If there is something bigger there, then obviously we'll look at funding that separately. We continue to discuss opportunities with clients to engage with them at a more strategic level in terms of some of this outsourcing. Obviously, as they see the progress that we've made in building our business, and we are now really quite visible within the games industry as a whole, they're starting to engage with us in discussions about, you know, how we can help them to re-engineer their business. You know, again, I don't know exactly how long it's going to take for some of these discussions to come to fruition, but I'm very, very convinced that over time, this industry will progress to something that's more akin to the movie or the film industry, where all production is pretty much outsourced. So, in terms of the outlook, we've had a very good first 3 months of the year, which is very much in line with what we were expecting. We, as David signaled, we're investing quite substantially in supporting this organic growth of ours. So around the world, we are putting in expansion space or moving from premises that's somehow constrained to something that's much larger, as we've just done in Tokyo, for instance. I think we've actually trebled our space in Tokyo because we were busting at the seams with more business coming in, and we had no choice but to move. So there'll be some capex going in. There'll also be some opex associated with that while we ramp up the utilization of that space. Into 2017, it's more of the same. The strategy is working very nicely for us. We're not about to change anything. So more acquisitions, strong organic growth across the board, I hope, and with some very good cross-selling activity that's already underway that's going to come to fruition both in the second half of this year and through into 2018. The pipeline for acquisitions, people sometimes ask, well, aren't you running out of targets? The answer is absolutely not. There are lots of businesses out there that we could acquire. It's certainly not anything to do with availability of decent businesses. It's really a question of us deciding what we want to do when, and that we can comfortably manage and integrate, of course. Final slide to leave you with is the investment case. A bit of a reminder. So I think the way we're seen in the market is that we provide access to the video games space in a way that de-risks an investment that could have been in a single game developer, for instance. So it's not about the hit or miss of a single title. Our opportunity is really broader across the entire game space. Key drivers are obviously the fact that the market is growing strongly. This trend towards continuous and higher definition content drives our business every single day. And then beyond that, you have the trend towards outsourcing, which again is a very strong trend. And if any of you get a chance, there was a conference recently, the External Development Summit, I believe it's called, in Vancouver a couple of weeks ago. And there's some pretty good video content available from that online. And you'll see people from inside the games industry talking about how important outsourcing is and how their demands for it are growing. As a business, we continue to execute strongly. I think that's something that the market has come to appreciate from us. Not only do we tell people what we're going to do, but then we then go out and do it. And that's not always the case. So, we're very proud of our record of actually just getting on and executing. We provide ourselves and our investors with a significant opportunity to grow through geographic diversification, through extending our service capability, and generally leveraging our client relationships. And the final point to make is just that our business model, being a time and materials business, and the management structure that we've put in place, is there to support this growth for the foreseeable future. So I'm going to wrap it up there and take any questions.
Hi, it's Paul Morland from Canaccord. A couple of questions. One was on the localization business, which you said is just reaching a tipping point. I think it grew at 6% organic in the first half. Was there a tough comp there? That's the first part of the question. The second part is, who are the main competitors in that localization space? Are they game specialists, or are they the more generalist linguist companies?
So actually, I think you're mixing up the two businesses, localization testing and localization. So localization grew 30% actually, organically. Localization testing grew 6%. So localization, which is the translation business, which is what you're asking about, that has grown very strongly. The competitors in the space are a bunch of small single language focused companies, often associated with the audio business as well. In terms of multilingual players that can do all languages and that are specialized on video games, there really aren't many of those. The competitors are more likely to be seen to be the general multilingual localization players, companies like Lionbridge, SDL, and so on. They would be a more logical competitor to Keywords, but they don't play very strongly in this space.
My second question was just around the lumpiness of the business, and I think it was when you were talking about the audio business, you said, it can be very busy in June, but the revenues might slip into the second half. Can you just explain how your revenue recognition works? Because it kind of sounds like a more time and materials type business, and so you would have thought you would accrue revenues in the first half, but clearly you don't.
Yeah, no. So it is a time and materials business, and we bill for work that we do in the month at the end of the month. So we're not sort of pre-booking any revenues in expectations of revenues to come or anything like that. When we do the activity, we basically are spending hours or days of recording time or whatever it is, and then we will bill for that at the end of the month. So in terms of your question about the lumpiness, there are some service lines that we have within the business that are lumpier than others, and some that are very non-lumpy. Something like the customer support business is very steady. It's X number of people allocated to a game kind of forever. Whereas a business like audio is more driven by big AAA titles coming to market. So getting those ready and getting the content in the game ready for release in November or October, November for the Christmas period, or a secondary release window for those games is often February, March time. So there is a bit of lumpiness in some of those areas, but overall throughout the business we're finding that the lumpiness and the seasonality is being flattened as we grow the various service lines, and some of them are a little bit counter-cyclical as well.
Just on these investments into sort of the capacity. So is that investment just for sort of forecast demand, or is that rather you've seen demand that's there and you maybe have to turn some away, and that sort of prompted the 25% increase in investment over, well, we've already seen the capacity almost double in the last 12 months. And then second to that, it's concentrated on 3 areas, bar engineering, and I would sort of explain that logic in using maybe M&A more there than sort of organic investment.
So the first question is what's driving the expansion. So it really is that we're bursting at the seams in some of our locations. So obviously you try to time the investment just right. You don't want to put in a whole bunch of investment and have it sitting sort of vacant, waiting for the business to come in. So in these locations, like I mentioned, in Tokyo, in Montreal, for instance, we're bursting at the seams. So we're either having to turn work away, which we hate doing, or having to expand fairly rapidly to capture that opportunity, and we're choosing to do the latter. And then having decided that we need to expand, the decision is always, do you expand just enough for the current demand, or do you expand a bit beyond that? And we've chosen to expand a bit beyond that because we see the overall demand and have a very positive outlook. Your next question was about the three areas to concentrate acquisitions.
And maybe more on why it wasn't more put towards engineering, market size, as known to me, is quite large in comparison to some of the other verticals.
So why we're not targeting engineering more, did you say? Yeah, no, we are targeting engineering. So we have a very healthy pipeline of engineering acquisition opportunities. It's a simple question of timing and getting those deals through the door. So you will be seeing engineering acquisitions coming into Keywords. One of the real attractions of engineering, it sort of goes a little bit beyond engineering itself. It goes right into the heart of what is a game developer. And if you're in that engineering phase, a lot of that engineering comes with art associated with it, and it comes with obviously downstream work as well. So we're already, for instance, in our game sim business, see good opportunities to cross-sell our service line more generally. We're confident that with this trend towards co-development, we're going to be able to sew more and more services together into a sort of package delivery into our client. Dan, yeah.
Yeah, you talked a little bit earlier about potential of doing larger acquisitions. Would you ever consider something that's not accretive in order to build the platform, or are you mentioned that some companies would be doing this privately? You've obviously got a rating to go into. Would you consider something more strategic, less accretive?
I think it's fair to assume that if we do a larger deal, it might come at a higher multiple than some of the deals we've done so far, just because they've already got a fairly substantial piece of the market somehow to come with them. I would hope not to get to the point where we're doing deals that aren't accretive. I mean, I think we've got plenty of opportunity to do some very accretive deals before we get to the point where we need to consider making non-accretive deals. Having said that, if there's something very strategic out there that really just totally solidifies the entire business or whatever, then obviously we would consider it. And then
also in acquisitions, you have talked previously, and you've made some movements into adjacent markets. Is there any defined strategy to move into those markets, or are they still going to be sort of add-ons with other stuff you're buying within games?
Yeah, I think for now we have so much to do within games that we don't feel the need to go out and sort of diversify into adjacent markets right now. But we continue to keep an active watch on what's going on there. And some of the acquisitions that we make will take us more into some of these neighboring areas, but not necessarily in a massive, through a massive bet on them. It'll be a little bit more to get us a little bit of exposure so that we can see what's going on, while still having them focused largely on the games opportunity.
You talked a little bit about the opportunity with mobile and localization testing. So wondering if you could give us a feel of the budget for a title, let's say if it was on a console, in terms of what the budget split would be between localization and localization testing, let's say 50-50 or whatever it is. And could we see that trend possibly extending to mobile, in terms of what growth we might see in localization testing for mobile,
yeah.
Whether that would also extend to possibly also functional testing?
Yeah, so functional testing is something we do a fair bit for mobile already. Localization testing, we're doing more and more. There's always been a little bit, but some of the bigger mobile games now are spending what I would say proper money on localization testing. I think in terms of budgets, if you look at a console game, and it's hard to generalize, but you might have about, as you say, about 50-50 spend between localization and localization testing. Whereas in a mobile game, across the board for all mobile, I would say it's probably more like 90-10 at the moment. But we certainly have some clients that are spending as much in localization testing for mobile games as they are in localization. And we hope to see that continue, because quality does matter, and these mobile games are now, they're so big, so important, and I think that the players really are demanding that the quality has to be right up there.
Just second question. Appreciate you might not want to answer it, but the revenue generated by 3 or more clients. I'm guessing that that's significantly more than the 20% of the clients. So
it is. I don't have the numbers to hand, but generally speaking, the clients that are buying 3 or more services tend to be the larger clients, which is more or less what you would expect, I guess. For 2 reasons, obviously, because they're buying more than 3 services, they're logically spending more money with you, and you've got bigger share of wallet. And the other reason is possibly just because it's the obvious place for our sales team to focus in terms of getting more business, because those bigger clients have bigger wallets. So.
And just lastly, the co-development, is that something that new is? Could you speak a little bit more about that?
Yeah, it's really something that's become a bit of a buzz in the industry. So a lot of talk about co-development, some very sort of exciting case studies from some clients and engineering companies that have undertaken projects where previously the sort of work would have been done entirely internally is now being done, where a big slice of the game or a big part of the game is being outsourced to a partner, an external partner, while the internal studio or studios concentrate on another segment of the game or another section of the game. And I think that's a model that's going to be continued to be pursued by the industry generally, because it helps to leverage that, the issue of these games being so big that a single studio can't scale up enough to do all the work in-house. It just doesn't make sense. So using co-development partners as an extension of that team is a good model. Kevin, yeah.
Thank you. I appreciate you've got a lot on your plate, as you said, with gaming before you go into film, TV, learning and everything. But I was just wondering, and you mentioned it at the beginning, in the field of AR, there's obviously a huge commercial opportunity there, and whether you're actively looking to benefit to go at that right now, whether indeed you're getting inbound queries at the moment from this area.
It's a very good question. We are doing some exciting work in AR and VR that's not games, but uses a game engine. So it's all inbound work. I mean, we're not hunting for it. It's finding its way to our door. A good example would be, for instance, can I mention this? No, I'm not sure if I can mention it. So, but yeah, I mean, there's a very high-profile retail application that's been showcased, and we're working with that. So nothing to do with games as such. It's a retail experience, but it's using augmented reality.
Yeah, that's not something there is really nothing to acquire, I guess, at the moment, but that's something you can just build up internally.
Absolutely. I mean, we have the capabilities for that. So, doing the art, the engineering, in fact, GameSim, the company that we acquired that forms the beginning of our engineering business, that's actually very closely entwined in a co-development type engagement with Magic Leap, who are one of the leading developers of augmented reality development. So we're in that space. We understand it from all sorts of angles, and the work is finding its way to our door. One of the challenges for us, obviously, going forward is to try and find out a model where we can let more of these companies know about our capabilities. We can't do that through the direct sales force that we've got.
Just on that point, as you scale, have you thought about, your brand as a possible limitation or lack of thereof? I mean,
We've just rebranded.
No, but you know what I mean. It's
Yeah.
a very fragmented brand strategy.
Yeah.
In terms of as you scale, do you think that you're going to get the keywords brand is only one part of the operating business?
Yeah, well, it's actually kind of interesting. So the whole subject of brand and what it represents and whether it sort of holds us back or not. So it used to be that keywords, the name came from the fact that we were a localization company, so we're doing things with words. And then people would say, well, are you a search engine optimization company? No, we're not. We're a localization company. Interestingly enough, in the engineering space, for instance, people talk about keywords without having any idea that actually the origins of the business is in localization. Same thing is true in art. People talk about keywords art. They have nothing in their head that says that keywords is a localization business. So I think as we go into other adjacent areas, I think keywords will just come to mean what it means, which is this services capability around interactive content. And so I don't think the brand itself will provide any sort of limiting factor. What I do think is obviously that skills will be in high demand. So we're going to have a big demand from outside games for game skills generally. The entire industry will face this because enterprise solutions, whether it's retailers, whether it's corporate training, whatever that's using AR, whatever it is going to be coming after the sort of skills that we have got as an industry within the game space. So that's going to put a premium on those people with the skills, which I think will benefit us ultimately. And so for us, in my mind, the strategy is, how do we partner with the right partners that can get us access to this work that's going on outside of games without it becoming in any way a sort of distraction for us.